Hello, and thank you for having me as part of the lecture series this semester. My talk is titled Who Owns the Central Bank? Monetary Policy, Government, and Elections. I hope to share some of my knowledge on Fed, history of monetary policy, and its interaction with elected governments. The Federal Reserve, which is simply often referred to as the Fed, is the central bank of the United States, and it was created by the Congress to provide the nation with a safer and more stable financial system. It was signed by President Woodrow Wilson in 1913 with the Federal Reserve Act. And when we look at the key functions of the Federal Reserve System, we could see that monetary policy is the main one. And apart from that, helping maintain the stability of the financial system as well as supervising and regulating the financial system. On top of that, we have fostering efficient and safe payment and settlement systems, as well as promoting consumer protection against risks, and then community development. When we look at the key entities, we see three separate key entities, and that's by no accident. The framers of the Federal Reserve Act actually purposefully rejected the concept of a single central bank, and instead they provided a central banking system with three main features: a central governing board, a decentralized operating structure of 12 Federal Reserve banks, and essentially a combination of public and private characteristics. So when we look at these three key entities, we see how their relationship between each other and the Congress laid out in this simple picture. And so the Board of Governors is the main public entity. It is located in Washington, D.C. It has 7 members that are called governors, who are nominated by the President of the United States and then confirmed in their positions by the U.S. Senate. It's a government agency, it's a federal government agency, and then therefore they are directly accountable to Congress. They oversee the operations of the 12 reserve banks, and they also share some of their responsibility with them on supervising and regulating financial institutions and their activities. So all of the members of the board sit in the Federal Open Market Committee, which actually sets the monetary policy. So the Federal Reserve banks, there are 12 of them, as I said before. They are the main operating presence of the bank across the country. They were initially considered to be entirely independent the way they were originally envisioned. That meant that they could set the discount rates independently. So discount rates were at the time the most important monetary policy tool, which is basically it was an interest rate at which the commercial banks could borrow from the central bank. But as the concept of national policymaking developed and the integration across the nation improved and gotten more complex with the advancements in technology, transportation, communications, and financial services, effective policy conduct began to require a more increased collaboration and coordination. And this was essentially accomplished by an amendment or a revision to the Federal Reserve Act, which created the modern-day FOMC, the Federal Open Market Committee. And so in terms of the monetary tools that the Federal Reserve has, the Board of Governors is responsible for the reserve requirements and the discount rate. And the Federal Open Market Committee is responsible for open market operations. I'll talk about those later, but they're basically sales and purchases of government bonds by the Fed. So essentially, all these tools are used to change the availability of demand for and supply of credit, and that is, available by the depository institutions. And these depository institutions are able to lend to one another at the federal funds market, and the main instrument as a result of the FOMC and the Federal Reserve is basically the targeting of that interest rate at that market at which the banks loan to one another using their balances at the Federal Reserve Bank. As I said before, all of the governors sit at the FOMC, and then the president of the Federal Reserve Bank of New York has a constant seat, and then the remaining seats are filled on a rotating basis by the other Federal Reserve Bank presidents. The non-voting presidents are still welcome to join the discussions. They participate and they contribute to the assessment of the state of the economy. However, they don't get the vote. So, although the parts of the Federal Reserve System share some characteristics with private sector entities, like the way that the Federal Reserve banks work, and then there's also the public part from the Board of the Governments, essentially they are established to serve the public interest. And when they were established basically over a century ago, they were done to respond or be accountable to the Congress, and that was specifically designed to carry out its responsibilities. Okay, but while they were carrying out these responsibilities, the Federal Reserve Act made a point of creating an independent central bank or independent Federal Reserve to basically stop such interference from occurring in the conduct of monetary policy. So what does that mean? That means that if the president is not happy, or the executive branch, for anyone from the executive branch is not happy with the conduct of monetary policy or the interest rate decisions of the Fed, they cannot fire those people. And so also the decisions do not have to be endorsed by the president, and the Federal Reserve doesn't receive any funding from the government. They actually get their income through their holdings of different financial securities that they gain through the open market operations. And they also made a point of having 14-year terms for members of the Board of Governors so that they don't overlap with the presidential elections and their terms, hopefully to achieve a further independence from fiscal policy making and private sector as well, and basically the electoral body. Even though commercial banks, for example, they get to sit at the board of directors of the Federal Reserve, they don't get to say anything about creating regulations for the financial system. Having said that, once again, the Congress, they are still accountable to the Congress on different grounds. One of them is their success in achieving the the economic objectives like maximum employment and price stability. And the chair of the Fed has to submit 2 reports a year, and they have to testify when needed to the Congress again about the state of the policy. So there are many different, and their financial statements get audited every year by independent outside parties. So there is this, given independence, but also that accountability to kind of, keep checks and balances. Now, that basically this little intro takes me to my main question that I started my talk with, which was who owns the central bank? Who owns the Federal Reserve? So as I just said, by law, the answer is nobody. So in its conduct of monetary policy, the central bank is by itself left to its own devices. Even though they have to answer for things that they actually do, they don't need to explain why they pick a certain policy. But this has not really been an easy. If you look at the picture that I have, I really like this. It says it's the political fight for an independent central bank. So it hasn't been really easy. So I'm going to talk a little about the operational reality, which we call de facto independence of the central bank. So if you look at the period between 1914 and 1951, we could see that mainly the Federal Reserve acted as a financing vehicle for the government. So this is starting with the World War I. And then it's especially at the time they didn't even. So actually, Secretary of the Treasury, Comptroller of the Currency, they were all members of the board. They sat in with the meetings. They actually presided these meetings, and the board didn't even have its building, so they actually had to hold buildings in the Treasury building. And so this was, by the time Great Depression rolled in, it didn't really help as well, because there were some missteps that were taken by the Fed, which kind of made them look even weaker and powerless in the face of economic policy making and their successes. And that kind of continued with the Second World War, where the Federal Reserve basically continued its role to finance government, especially at the very beginning with the First World War. Their main purpose was to provide loans to banks at a low interest rate, which then those banks used to buy higher interest rate war bonds. While at first the officers of the Federal Reserve seemed to be playing along with this, eventually this started creating some issues. The government started hearing behind the scenes talk about how this cannot be going on, how the Federal Reserve officers were being more wary of rising inflation and having an intention to increase the interest rates. But from the government standpoint, higher interest rates are not desirable, especially when you are looking at, these multiple wars coming back to back where you need to, as a government, borrow. Higher interest rates would just increase the government's borrowing costs, and that's definitely not desired. So these back and forth really reached a peak at the beginning of 1951, when basically Eccles, as he was talking about these, their disturbance with, rising inflation, he then was replaced by replaced by McCabe, which was appointed by President Truman. But Thomas McCabe didn't really do anything different in terms of, suppressing the sound. So the Fed continued to basically stir their wariness and talk about their worries about higher inflation. And that period gotten really intense to the extent that the FOMC members were actually called to the White House. And at some point, there was a press release by the White House which said that, the Fed is on board with our peg policy, which was not the case. At the end, that back and forth ended up with what we call the Accord that occurred in April 1951, and Bill Martin was then appointed as the chair of the Fed following that period. So while that was a major event in granting more independence to the central bank, it really wasn't the end of anything, because we had, following that period, we had the Vietnam War, and then efforts to finance the Vietnam War and pressuring the Federal Reserve to play along with that. And then we had President Nixon, and when he was trying to, he actually in his memoirs openly stated that, the Federal Reserve policy killed his chances to get elected. And then, so he wanted to increase employment and wanted the Federal Reserve on board with that in 1970. And his appointee of the Fed, Burns, was very much on board with that. It wasn't necessarily a politically motivated act, but it was rather, he believed in a different model to lower inflation rate. Burns. He thought that a lot of the inflation that the country was seeing at the time was basically because of rigid labor union contracts, the wage contracts, and that monetary policy didn't really play a big role in adjusting or lowering inflation. So they had a mutual understanding of that. So he kind of tacitly promised easy money in return for, efforts by the government to kind of soften those, their impact on the wages, to lower the wages and potentially cost of production. And that didn't really go well because the United States ended up having high inflation rates all the way into the early 1980s. This seems like it's in the very much past. Did we have anything similar in the recent future? Yes, recent past, yes. And that would be Great Recession. So if we look at the aftermath of Great Recession, we could actually see the Representative Ron Paul writing a bill of the Federal Reserve Transparency Act, Senator Bernie Sanders introducing Federal Reserve Sunshine Act, and then the new another new bill later on, Audit the Fed was the name for it. So we could see that there was actually a growing, let's say, unhappiness with the way that the Federal Reserve handled Great Recession, which was basically taking some unprecedented measures, which resulted in a huge financial balance sheet for the Fed. And some members of the Congress wanted the Federal Reserve to basically be more open about sharing this vital information, why they did what they did, and who did they help, etc. And even now, you could basically see this kind of back and forth. The current chairman of the Fed back in 2015. And then former chairs of the Fed responding to such basically criticism of the Fed. So that takes me to what is going on now, what it means for the election, and then also talk a little bit about what economics research has to say about these issues. Okay, so what about now? Let's have a look at what the experience of President Trump with the Fed during his first term. So we know that during his campaign he often criticized then chair of the Fed, Janet Yellen. At some point he said that I think she should be ashamed of herself. She's acting very political. It's not supposed to be that way. And then by November 2017. President Trump has nominated Jay Powell as the next chair of the Federal Reserve to replace Yellen. And at the time, that was actually quite an unexpected choice. So Jay Powell was already on the board. It was unexpected in the sense that he wasn't an economist by training, but he spent a lot of time at the board that, at least Federal Reserve had trust in him. And apart from that, he also appointed, including him, he appointed 4 governors, so vice chair, and then other seats. So that was sort of initial thing. So, and then you're thinking, well, he appointed, and that was actually, he was breaking tradition by appointing Jay Powell, because usually what we've seen for decades was that the incoming president just kept the chair of the Federal Reserve from the previous government. But that didn't work that way. And that didn't necessarily promise a good, relationship with the Fed that was going in harmony. So they have some, I read a lot of accounts of different historians as I was trying to, prepare for the history of the Fed that I wanted to share with you. But with the current history, it was a lot easier. I just had to basically go populate some tweets from our president, and you could see there the clear negative relationship between President Trump and the Fed. So here I have basically a tweet where he's talking about how when Jay Powell said that, trade wars are creating a lot of uncertainty and they're not good. And he was like, oh, are you the enemy? And then there was also the issue about, during the 2018 when the Federal Reserve was, they raised interest rates, then he was basically unhappy about that, creating a strong dollar, affecting trade balance. And so this is actually going to be important. Let me step back here a little bit, where he's saying the Democrats are trying to will the economy to be bad for purposes of the 2020 election. So there was basically a hint about, the letting the economy perform badly to hurt his chances of re-election in 2020. And I have some more basically going along with the same or similar sentiment towards Fed policy of being wary of inflation at the time. I think the latest one was from World Economic Forum meeting in Davos, where he said that, look at the negative interest rate policies of Japan, Germany. Those governments are able to borrow much cheaper. They're basically getting paid to borrow money, and I could get used to that. Why are we paying these higher rates on our government bonds? And he basically took while he said that our economy is doing great, it's no thanks to the Federal Reserve. So that was sort of the sentiment, of President Trump with the Fed. And if we kind of try to have a forward-looking view and try to understand what we should expect going forward, we know that President Trump picked a nominee, Judy Shelton, and it's an unorthodox pick in the sense that she has quite different views on monetary policy. She supports gold standard, and he also not recently I couldn't find, but during his 2016 campaign, he said that he supports audit the Fed, which is again asking Fed to basically share their control over the monetary policy by providing more vital information about that. If we look at the other candidate, from various answers that he has given in the past, it seems like he is more in favor of let the Fed be, let them do their thing, and I'm not going to intervene in. And he's like, no president or any candidate for president even should meddle with or intervene with monetary policy decisions. And I think one of the charges that he saw fit that kind of became prominent in terms of his approach to Fed was employing or utilizing Fed in fighting certain economic gaps that we see in our demographics, racial gaps, maybe gender gaps, so on and so forth. So that's so far what we've seen historically. So if somebody, was seeing those tweets for the first time and thinking that, oh my God, this is new, it's actually not. So we have seen in the history of the Federal Reserve these kinds of occurrences quite often. So then what? What does that mean for the election? So there's actually a couple of things that we need to think about here, and then that's sort of going to the economic research that I wanted to cover very quickly. And that is that if there is this much intervention and meddling going on, and the fact that it exists is in itself evidence or argument for having independent central banks and independent institutions like the Federal Reserve, then do we actually see any impacts of that? So do we actually see any patterns in the data where we see political influences and business cycles or short-run fluctuations in our economic growth data that could be driven by these electoral election years and these sorts of political influences? The theory is twofolded. So the main model that we have is the opportunistic business cycles, where we have an incumbent that has power to manipulate macro policy to create economic outcomes that are favorable to them, to increase their chance of re-election, or I should say favorable to the voter so that they can increase their chances of re-election. And then the other theory is the partisan business cycles, where it says we could see electoral cycles resulting from different parties having different political objectives. So basically, with the opportunistic business cycles model, we have voters who want low inflation and they want low unemployment. And an opportunistic incumbent policymaker doesn't necessarily care about any of these things. They only care about being reelected. And then, therefore, they try and stimulate the economy before the election to reduce unemployment. And with the way with the monetary policy is that an expansionary monetary policy, which is buying of the Federal Reserve, buying of government bonds by the Federal Reserve, would lower the interest rates and, basically try and stimulate the economy, create more jobs and reduce unemployment. But the cost of that is in the going into the future, you should expect to see some inflation. And the idea there is that they would, stimulate the economy prior to the election, get reelected, and then reverse those policies after the election to kind of stop inflationary effects. And the assumption about the voter in that framework is that voters are typically, short-sighted, so they are very myopic, and they use adaptive expectations about understanding economic outcomes, especially inflation. So their best bet for what the new inflation is going to be is the previous period's inflation. So they don't have that forward-looking approach to like, hey, interest rates are being lowered today, we should expect higher interest rates. Well, they don't have that. They look back and they say the inflation is going to stay whatever it was the past period. The partisan business cycle one is, again, it basically picks these particular policy objectives or economic policy objectives for different parties. And then, for example, if you're looking at a party who values lower unemployment more than they value lower inflation, then they would tend to use more expansionary policy. And then you may basically see different cycles in the life of the economy depending on the ideology of the policy maker. So here, what does then, so these are all theories, right? So what does the empirics say? One of the things that, as people started to study these models, realized that maybe let's change one of the major assumptions here, which is this backward-looking voter. Voters are more rational than that. They would utilize more data. They understand models better. So what they would try to do instead of looking backwards is use this data to understand the unobserved. So try to make more sound expectations about what's going to happen tomorrow. So both strands of the literature started using more rational expectations, assumptions regarding the voter. But what that did was, usually the common way to do that would be, let's say, having these unobserved characteristics of the leaders and trying to use the available data to infer about these characteristics, one of which is competency. So how would you infer about the competency of an existing leader? You look at the economic outcomes they achieved. So if during the election year things are good, we're still having, I would say, an accurate depiction of consumers who are looking at the near past rather than the distant past. So you're looking at folks who are looking at the current economic situation and saying, well, it looks like the incumbent is capable enough to achieve this. So here is my idea of his competency level. So the sort of the implication of that, whether it was used by, again, either strand of the literature, was that it put a weight on the current economic conditions. So good times suggest a competent leader, so that will increase their chances of re-election. And that's kind of what we've seen anecdotally in the history of the Fed, that, whenever times are bad, Fed will be blamed for it. If times are good, credit will be taken. I did this, so, I should be re-elected. But what about the empirical evidence that's provided by economics research? It is quite mixed. As a matter of fact, when we look at the evidence on opportunistic business cycles, a lot of the, especially a lot of the evidence on existence of political cycles is weak, and specifically for developed economies. In terms of the water response to economic conditions, that is also mixed in a lot of the cross-country studies, except for the United States. As a matter of fact, in some work by Ray Fair, he basically had this equation, and I think he keeps updating it during prior to election years. I think the latest one from 2018, where he actually found out for the United States an increase in real economic activity, that which could be measured by real GNP per capita or change in the unemployment rates during the election years, has a strong positive impact on the incumbent's vote. So for the United States, we actually see, at least he's not the only one. There are actually other work who sees this positive relationship between economic conditions right before the election and results of the election. When it comes to the partisan business cycles, we don't, for a fact, they are less empirically tested, but one of the regularities that popped up there in the existing work was that when we compare the terms of the Democratic and Republican presidents in their first term, especially in the first part of their 4-year terms, Democrats had a higher level of economic activity, but during the last 2 years of their terms, both parties or presidents from both parties achieved similar economic outcomes. And when we look at the cross-country studies, there's basically no significant evidence that says that there are such cycles, especially with countries with independent central banks. So, what can we then say is that in terms of which model it does the best job predicting what really happens, we don't know. But again, there's still some anecdotal evidence that we cannot really ignore. So if you look at these election results from year 2000 and year 2016, you could see the counties that voted for George W. Bush and Al Gore, they are pretty close, right? And that was sort of the result of that election. It was a close one. But if you look at 2016, the counties and the GDP or their share in GDP as a nationwide is only 36%, while the counties that Clinton won, the share of GDP is 64%. You might say that, well, it could be because Clinton won maybe in more dense population areas, so therefore their share must be higher. So we could look at some other numbers like economic growth, for example. What we found when we do that was that, so 2015 we had an economic growth rate of 2.9%, which then dropped significantly in 2016, which was kind of an off year, and I think it was like 1.6%. So when you look at the counties, the economic growth in the counties that Clinton won, it was 1.8%, which was higher than the national average. But if you look at the counties that President Trump won, the overall growth rate was barely 1%, and in maybe almost slightly less than 50% of those counties, there were actually recessions going on, meaning the economy in those little regions were actually contracting. So here you can see that there's more like evidence of, at least in the recent election, sort of a growing unhappiness with the economic condition, and this is sort of as anticipated or as predicted by the policy and the model of the rational voters and whatnot, that growing unhappiness with the economic conditions in those regions prompted in favor of President Trump. So we understand that, okay, well, there is support for there's no support for politicians manipulating macro policy to get what they want. And there is some support at the United States that folks, voters, look at the current or near economic conditions to make their choices when they are voting. And that kind of support those models, because in those models, that's the incentive for the politician to better the economy so that they can get elected. I guess another thought, maybe a kind of an ominous and skeptical view, would be, what if the direction of the influence is not from the government to the Fed, but from the Fed to the government? Okay, so correlation, causation, maybe we have to kind of look at that with a little bit more detail. What if the Fed is trying to influence elections? Are the folks at the Fed affiliated with political parties? Yes, they are, and actually that is public information. So if you go on to any kind of information about any of the former chairs of the Fed, you would find whether they were Republican or Democrat. So, for example, for Jay Powell, and then the other governors that were appointed by President Trump, you can see that they are Republicans. If you look back, Janet Yellen was a Democrat. Prior to her, Ben Bernanke and Ellen Greenspan were Republicans. Paul Walker was a Democrat. So you can kind of go back like that. Burns was a Republican. So you can kind of see that there's actually that common knowledge. But there is really no evidence that suggests that those officers of the Fed acted in line with those in picking their monetary policy. Usually they have this dashboard approach, and that's why they have a committee of all kinds of diverse opinions. So and there's a voting that goes on, which would then dilute those kinds of personal, differences. So then, if we want to really understand whether the Fed has those, incentives to act one way with one president, or assure election or not election of certain presidents, we could look at how they use their monetary policy tool, because that's basically the thing that we're trying to understand. That's what creates these cycles, right? So we said that their main instrument is the Federal Reserve, federal funds rate. So what we see when we look at the data, I'm going to step back here a little bit more, is that if you look at these orange lines, which are 2 months prior to the election, you could see how, so on the y-axis we have the federal funds rate and how they changed it. So you can see they lowered it, kept it same, kept it same, kept it same, kept it same, and then increased it here, right here, which was a rare event. And then here they lowered it and then kept it the same. So when we look at the monetary policy during election years, it seems like the Federal Reserve typically chooses to stay low. That means try not to do anything drastic, but definitely a lot of the times it means do not raise the interest rates. So this is actually quite important in terms of understanding the relationship and these political cycles, because it's basically saying that in order to protect its independence, or in order to act in line with its independence, the Federal Reserve is trying to remain neutral, okay? But by their design to remain independent, and they also know that they are not indifferent to the political implications of their policy decisions. So as a result, we could very well observe a political cycle where the tools of the monetary policy are used such that they are expansionary, or at least they are not contractionary during election years, even though the monetary authority doesn't have any motive to help or change or influence the election results. So this is quite interesting in the sense that by choosing to lay low, the Federal Reserve might very well be impacting the results of the policy or of the elections, basically. So the main takeaways that I see that I got basically as I was preparing for this lecture was it doesn't, again, it's hard when you look at international data, especially, it's hard to find, especially in the developed world, it's hard to find any strong evidence of politicians meddling. And there's also, if somebody were to ask, there's also, like, if I'm the current president and I want to influence the economic outcomes, I could very well use fiscal policy. And there's actually a growing research on the importance of political budget cycles. But one of the issues with the fiscal policy is that its results are rather distributional than aggregate, like those of the monetary policy. So there is room still for looking at monetary policy to achieve some of the outcomes that they want. However, while we don't see the impact of meddling, we see definitely a strong preference by the voters for the good economic outcomes. And while, again, the Federal Reserve doesn't intend to do it that way, by simply being aware of their impact on the political outcomes through their impact on the economy and trying to stay neutral, by not doing anything, really, they might actually be doing something. So I hope that you enjoyed this talk. I really enjoyed preparing for it. And if you have any questions for me, you could email me. I won't be able to sadly see you face to face, but again, don't hesitate to reach out. Thank you.